It's the Real Estate Podcast, brought to you by ANZ Home Loans for financial well-beings.
Hey, welcome back to the Real Estate Breakfast, another episode of looking back over what has been an incredible busy 2025 year. It is a Sunday. You can hear us on all sorts of different platforms. Make sure that you subscribe, never to miss an episode. There are so many, over 1,500 episodes. We try and cover off all of the suburbs around Australia, but there are so many. Coming up next, we are back to our summer series of real estate.
You're listening to the Summer Series on the Real Estate Podcast.
Body corporate fees at the moment in Queensland are just going up and up and up. I know you can probably expect to pay about, $5,000 per year in Brisbane, and that's not for a high-rise tower. That's just for, a smaller complex, no swimming pool, no elevators. And I think the key reason for that here in Brisbane is insurance. Our insurance costs have gone through the roof, because we've got a lot of natural disasters up here in Queensland, and also the cost of construction has gone up so significantly as well. So insurance payers have to pay out more, therefore they increase their premiums.
Yeah, body corps are an interesting thing. You're working there in the space as a buyer's agent. Do you find, from time to time, there are these people, they love to engage in a really deep dive when it comes to body corp. I don't want to call them troublemakers, but you know the types. They go, no, you can't do that. In this case, we've got the pot plant, but it's not just the pot plant. There's multiple things that people can get their sort of noses out of joint and put their nose into other people's business, dare I say that.
Yes. I know as well, in particular in the complex that I live in, there has been one of those neighbours who just has an absolute fit over anything that's not 100% within, the body corporate bylaws. I remember at one point in time, I had an air conditioner installed and the condenser piping that had to, remove the water from the property, it went over common property and she absolutely lost it. And we had to spend a few $100s to go and remove and relocate that pipe elsewhere. So there's always going to be those people. And look, I actually don't think it's the worst thing in the world. I would rather have someone who really cares than have no one in the complex who cares. And I've been to some complexes where no one cares and it's just full of investors and, you trip over the burst sewer main on the way in. The balustradings are all falling apart. No one's reporting issues at the complex, retaining walls, things like that. So I normally suggest to people, I'd be happy to pay slightly higher body corporate fees if they're actually spending the money well and the complex is being taken care of.
Yeah, and just since you're talking about the developers, want to talk about the rooming accommodation. Now, investors, what they're doing here is they've seen a bit of a gap in the market, and they're setting up, in many cases, multi-rooms in houses. I'm not too sure how many of these are in apartments, but they've got their own ensuite. Some of them are making the rooms large enough so that you can put a settee in, you can put a writing desk, almost sort of self-sufficient, use the main kitchen, etc. That's pretty smart, I think, in today's environment.
I think it's a good way to assist with this housing crisis and rental crisis that we've got going on at the moment in Brisbane. So yes, I'm seeing this quite a lot. Developers or even just, your mum and dad investors will buy a block in Brisbane that can be subdivided. And what they'll then do is they'll build two of these dwellings. Now, you're very right. Most of these dwellings, depending on who builds them and how they're designed, they'll have 5 bedrooms with 5 bathrooms and 5 little kitchenettes. And then they'll also have one big living space and a larger kitchen as well, which I find generally don't really get used. And then they'll have 1 or 2 car parks. Now, if you were to purchase one of these for anywhere below about the $1.4 million mark, you add in your subdivision costs, you add in your build costs, you're still going to get about $400 to $450 per week rent on these, which means that all costs in, you're still getting about a 9% return on your money, which is pretty much the only place that you can get that kind of return in real estate at the moment. I'm hearing a lot of self-managed super fund investors are also looking to purchase these. You can't build them within the self-managed super fund, but you can buy them. And it's just a great way to get that rental return and almost use it it as a land bank strategy in a more blue chip location.
Good morning to you, David. Welcome back to the Real Estate Breakfast. And what do you think? Do you think we'd be better off back in the 1950s? How fast is 2025 going for you?
Craig, you're a beauty. I was born in 1961, so I'm not sure what year you were born, but I grew up in Perth along the beaches near Scarborough Beach. Even some of my friends who were in social housing and so on lived a kilometre from the beach, and, we used to surf and skateboard and do all those things on the beachfront. These days you need $1 million to live there. In many ways, if I could wind the clock back and know what I know now, I'd maybe take the 50s, 60s, but I'd be missing my iPhone and my Facebook and my chat GPT. So I'm not too sure in real life whether things were always as we look back and see them, Craig.
Yeah, I probably, if I was to pick a decade, just having a little bit of fun with this, I would want to forever live in the 1970s. I loved the 1970s growing up as a kid.
We had a lot of freedom as kids, didn't we? You'd get on your push bike after school and nick off till it was dark, and your parents never knew or cared where you were as long as you came home for tea. Those kind of things were part of our era back in those days, which is no longer the case now, I guess.
Well, my poor old mum, she had three of us. She was a solo parent and trying to struggle, with three children. I didn't have a bicycle, and those choppers, I had to go and steal the neighbour's chopper.
What about a skateboard? Did you have a skateboard?
Oh, yeah,
you weren't that deprived, were you?
Yeah. No, absolutely a skateboard crazy kid. Yeah, crazy kid. Yeah, and then just coming back to this Fraser Hotel last Thursday, a little bit of news around the sale of this.
That's right. So they paid more than $100 million, the state government, for the former, what we know in Perth as the Fraser Suites, which is a luxury hotel, or was, for social and affordable housing. So it's a 19-storey tower, Craig. And their plan is to put Perth's, and I'm quoting the government now, Perth's poorest people into luxury accommodation that once cost honeymooners and executives $320 a night. And it's the most costly acquisition ever made under a state government spot purchase program. So up till now, they've been buying, and I've sold some to the state government, they would buy one unit per complex. They didn't want to have more than one in the complexes, so they would buy spot units, which they then would put in their social housing program. But in this case, they've decided to allocate half the apartments. This is at 10 Adelaide Terrace, for those that know Perth, so right in the heart of the city. And it will be leased as affordable housing for low-paid workers, and the remainder will be rented to social housing tenants who are drawn from a wait list. And get this, there's 22,000 applicant households here in Perth. That's why there's been enormous pressure on the rental market here in Perth, and the vacancy rate got as low as 0.7%, which has never been in the history of recorded real estate here in Perth. So that's been over the last 24 months, it's been that low. So the state government's really been forced to do something. And obviously, we've had a great share of royalties here, and the budget's enabled them to allocate that. That is part of what they call the rent relief program to support tenants in hardship. It's also, they've allocated $75 million to build to rent kickstart fund, which is that micro apartments you're also referring to, Craig.
And despite renewed momentum, housing turnover remains below average at 4.9%, you guys have reported, and advertised listings are down nearly 17% from the 5-year average.
Yeah, that's right. So basically what we've got is a housing market where values are higher, but the actual act of buying and selling property is lower than usual. And the reason we think that is because of some of the recent economic and geopolitical events weighing on confidence. And so people are just kind of holding back from the market, waiting before they jump in and make big decisions around buying and selling homes. There was also the fact that turnover was just so high in 2021 when interest rates were at a record low that probably brought forward a lot of buying and selling activity a few years back, and not as many people need to transact at the moment.
And talking of transacting, regional markets still outpaced capitals quarterly, but growth momentum is shifting back to major cities, which you guys have also talked about.
Yeah, this is really interesting. So over the start of the year, we've basically seen a bit of an outperformance in regional Australia. In the June quarter, regional home values were up 1.6% compared to 1.4% in the capital cities, which we put down to things like more affordability in regional Australia and stronger internal migration trends. So less people leaving the regions, more people going to the regions on average. But over the past couple of months, including the month of June, we've seen that the capital cities have actually outpaced again. So they've kind of retaken their advantage, if you like. So capital's up 0.6% in the month compared to 0.5% in regionals. And it could be that as we move forward in the course of the year, the capital city market could actually start rising more quickly. And that's basically a function of lower interest rates as well, because higher priced markets tend to have a stronger reaction to changes in interest rates.
And that story, such a great story about these women very vulnerable and in that particular case, Diana, a very positive outcome.
Absolutely, mate. Yeah, thank you very much for having me back on the podcast. It's great to be here and have a bit of a chinwag about how Bundaberg fits into the puzzle. But certainly talking about someone like Diana, it's an inspiring story and something that is pretty close to home up here in Bundaberg as we're such an affordable part of Australia. So we do see a lot of people hitting the reset button and often coming from times of hardship, and they want to come to a new part of the world and give themselves an opportunity to get back in and get back on board with saving for a house or getting into a house immediately. And we do provide a nice platform for that given our median house price.
Wide Bay coastline. Now, this is stretching from Elliott Heads to Bargara. So tell us a little bit about this because you'll be right across it, won't you?
Absolutely. Yeah, it's super exciting. Our coastline has been relatively underdeveloped for a long, long time. And I suppose that was part of its charm, particularly to locals. You could whip out there and drop a line just about anywhere and have a fish and you wouldn't even interrupt anyone. You'd barely see anyone. But that leads into the fact that there was clearly a lot of underutilised land. And when you talk about affordability and coming this far north of Brisbane, it's getting more attainable to get down to Brisbane and back for a day trip. So driving from Bundaberg to Brisbane now is 3.5 hours approximately, thanks to that Gympie bypass. So our mayor's tried to capitalise on that and free up some land. So when people do travel in this direction or locals want to invest in this direction, we certainly can look out to our coastline and see that there's a lot more land available. That particular stretch was dominated by sugarcane once upon a time, and our agriculture industries have diversified over the years to sweet potatoes, to macadamias and all those sorts of things. But ultimately, what's driving our region right now is that population growth, and we need somewhere for people to be able to build their homes. So Elliott Heads has always been a very sleepy coastal township, and it's got so much developable land out towards a beautiful little primary school out there. Bargara is a little more landlocked, I must admit. So a lot of that growth, as you touched on, is between Bargara and Elliott Heads. There's some out towards Moore Park as well, which is on our northernmost tip of our sort of part of this coastline. But particularly that Innes Park, Coral Cove, Elliott Heads, those areas are places that people will start to know as common household names. It's pretty much been Bargara dominating that side of things over the years, but I think those other three suburbs I've just touched on with the growth they've got planned and our Mayor, Helen Blackburn, being so proactive with opening up some of that land for development, it's only boding well for further growth in our region.
Now, we want to talk about Point Cook that you represent there in Melbourne. It is a thriving suburb located 22 k's southwest of Melbourne CBD within the city of Wyndham. And the population, this I didn't know, 66,000 people there, making it the most populated suburb in Australia, Archie.
If you didn't know those numbers and you came into Point Cook, you'd think it's just like every other suburb around metropolitan Melbourne. It definitely doesn't feel like it. Yes, we've had traffic congestion issues in the past, but they've done a lot, the council and Vic Roads, to duplicate and widen the roads coming in and out of Point Cook. So it's definitely helped over the last few years.
Now, you have worked through previous boom-bust cycles for over 21 years in the Melbourne real estate market. I want to ask you what makes the current surge in Point Cook particularly different from past cycles?
Yeah, well, I think what's happening in Point Cook, and it probably goes for most parts of Melbourne, is it's different from past surges because it's not driven just by emotion or speculation. It's driven by fundamentals. In past booms, we've seen rapid investor speculation, obviously loose lending and government stimulus overheating the market. Yes, we have a little bit of that in this market as well, but there's organic demand. So that comes from population growth at record highs. And Melbourne's leading the way. Interest rates are obviously coming down, like we touched on before, bridging the gap between rental repayments and mortgage repayments. So it's increasing borrowing power and allowing more buyers to get into the market. And housing supply is at historical lows. That's the difference that we're seeing today. And people are genuinely also needing homes rather than just buying homes to flip or do anything like that. So we're seeing families and first home buyers wanting to get into the market so they've got, I guess, a roof over their head and long-term security.
We connect you to the best real estate information across Australia. The Real Estate Podcast.